Hey traders, Ethan Roberts here for Mastering QQQI Trading. Well, today we're going to do something a little bit different. We're going to be looking at 3 high-income QQQ-related ETFs that you can buy and sell to create 40% a year in distribution yields and perhaps more when you include appreciation. And we're going to take a deep dive look into these in just a minute, so stay tuned. Well, today we're going to ask, can you really collect 40% or more in annual ETF distributions by rotating buys and sells among 3 QQQ-related high-income funds? We'll examine this fairly new strategy, the math behind it, and whether it actually works safely, and that's the key word, safely, in the real world. Well, first let's take a look at what high-income ETFs are all about. High-income ETFs are exchange-traded funds that sell derivatives like covered calls against underlying assets to produce extra income. They may also provide investors with dividends as part of the total income. The Nasdaq 100, which is represented by the QQQ ETF, has several high-income ETFs that pay distributions ranging from over 10% to about 16%, and these sell covered calls against the QQQ. The distributions may include a large percentage of return of capital. Distributions are generated through option premiums and tax loss harvesting rather than just standard taxable dividends. So we're going to look at something I call the 40% strategy. This involves buying 3 different high-income QQQ-related ETFs that pay distributions at 3 different times of the month to collect all 3 distributions, totaling a yield of 40% a year. Now, this is not just about dividing your money into 3 and holding these. This is about selling each ETF either on or after the ex-dividend date and then buying the next ETF in that month 1 to 3 days before its distribution date. You could also buy it sooner than that if we get a really down market for a day or two. Now, take note, it's best if this strategy is done in a Roth or other IRA to avoid the tax consequences of short-term transactions. Before we continue, I know people are going to have comments about the risks inherent in this particular strategy. So right up front, let's take a look at some of these risks and get them out of the way. In a protracted bear market, the principal loss could undo some or most of the distributions. When the ETF's price drops, so do the covered call premiums they generate. Therefore, the distribution amount drops as well. When an ETF pays its distribution, the price of the ETF declines about the same amount as the distribution. So if you sell right after the ex-dividend date, you could have a loss equal to or more than the distribution. And because the funds sell covered calls, the appreciation upside can be capped. In a strong bull market, these funds will lag behind the QQQ. Now remember also that a bear market typically can last anywhere from like a month, which we saw about when COVID hit, to say about 2 years, which we had when we had the real estate market crash back in 2008. So, the bear market could go on for quite a while, but remember also that bull markets are generally longer than bear markets. And when a bull follows the bear, its return is usually stronger than the amount lost in a bear market. Also, let me mention there are investors who are primarily looking for income. They tend to be older investors who are retired or nearing retirement age. Price fluctuations matter little to them so long as the income continues. Many investors are more than willing to give up some upside in exchange for the peace of mind of knowing they will continue to receive monthly income no matter whether the QQQ goes up, down, or sideways. And younger investors may also put these ETFs in their portfolio, but if they're still working and don't need the income, they're better off using a dividend reinvestment plan, or DRIP, so they can build up more shares of the ETFs over time. All right, let's take a look at the 3 ETFs we will be using in this 40% strategy. The first one is the Goldman Sachs Nasdaq 100 Premium Income ETF. The symbol is GPIQ. The objective for GPIQ is to own stocks in the Nasdaq 100 and seek to generate a combination of monthly income plus long-term capital appreciation. It writes covered call options on a portion of its portfolio, allowing it to collect some option premiums while still participating in much of the market's upside. GPIQ pays every month. The ex-dividend date is typically around the first business day of each month. The payment is usually about 1 week after the ex-dividend date, and that's really nice because you get that money right away. The current distribution yield is approximately 10.5% and is best suited for investors who want a balance between income and capital growth. Let's look at GPIQ's total return since its inception. GPIQ's inception was October 27, 2023 at $38.78 per share. As of June 30th, 2026, its price was $59.31, and the total return, including distributions, was 87.13%, for an average annual total return of 26.38%. If you had invested $10,000 in GPIQ on its first day at the opening price, it would now be worth $18,713.87, and the dividends collected during that time, $13.27. Well, you would have 257.84 shares and $13.27 in dividends collected times that amount of shares is $3,421.53. So without any appreciation at all, if GPIQ had never gone up at all, that would still be 34.2% in just 2.67 years, which is still far more than the 10.5% annual yield. All right, if we're reinvesting dividends, the total return jumps up to 100.71%, or 29.73% average annual return, and the $10,000 initial investment is now equal to $20,071.35. Your starting shares of 257.86 would now be up to 338.42 shares. That's a big increase in a short period of time. That 29.73% total return is far more than the 10.5% average distribution yield in only 2.67 years. Note, this does not take into account the distribution on July 1st, which was the very next day, so the amount shown here would even be larger than what is shown. Our second ETF is the TAP Alpha Innovation 100 Growth and Daily Income ETF, symbol TDAQ. Now, TDAQ also focuses on the Nasdaq 100, but they use a more active option strategy, selling 0 days to expiration covered calls. Because options are sold and reset daily, the fund seeks to generate a higher level of income while maintaining exposure to the Nasdaq 100. This ETF also pays once a month, typically between the 14th and the 19th day of each month, and the payment is just a few business days later. The target distribution yield is approximately 16%, and this is best suited for income-focused investors seeking higher monthly cash flow while recognizing that returns depend heavily on option income. Now let's take a look at the total return of TDAQ since its inception. Well, this is a very young fund. Its inception was September 4th, 2025 at $24.99 per share. The closing price as of June 30th, 2026 was $28.40. The total return through June 30th is 25.59%. So that's less than a year. Dividends collected thus far are $2.99. The annualized gain is 31.24%, and a $10,000 initial investment would now be worth $12,559. If we were reinvesting dividends, the starting shares of 400.11 would now be up to 448.56 shares. The total return is 27.39%, and the annualized gain is 33.44%. The $10,000 investment, dripping, is now worth $12,739. So the biggest problem with TDAQ is its short track record, but it's already been through two very rough months between February and March 2026, as well as a very bullish period from April through May of 2026. So we're able to see the performance through both good and bad months. And that annualized gain is certainly a lot more than just the 16% yield. Our third and final ETF that we're going to be buying and selling is the NEOS Nasdaq 100 High Income ETF, symbol QQQI. Now, QQQI owns the Nasdaq 100 stocks and writes covered call options using a very tax-efficient strategy. Unlike many covered call ETFs, it attempts to preserve more upside while producing substantial monthly income. It also pays once a month. Typically, the ex-dividend date is from the 16th to the 22nd of each month, but almost always it's going to be after TDAQ. The payment is usually within several business days after the ex-dividend date, and the current distribution yield is approximately between 14 and 15%. This fund is best suited for investors seeking a combination of high monthly income, tax efficiency, and moderate capital appreciation. QQQI's inception was January 30th, 2024, and it started at $49.84 per share. As of June 30th, 2026, the closing price is up to $56.79, and its total return is now 50.03%. The average annual total return is 18.30%. $17.98 in dividends have thus far been generated, and $10,000 invested at the inception would now be worth $15,002.48. If we were reinvesting dividends, the total return becomes 60.85%. The average annual total return is up to 21.76%, and the starting shares of 200.66 have now grown to 283.23 shares. A $10,000 investment made at the time that it first opened would now be worth $16,083.57. Well, these funds are very popular, and one reason that these funds have attracted attention is that their ex-dividend dates are staggered throughout the month. Early in the month we have GPIQ, mid-month we have TDAQ, and later in the month we have QQQI. This creates the possibility of a higher total return, but it also depends on price performance, option income, transaction costs, taxes, and how quickly each fund recovers after going ex-dividend. Also keep in mind that QQQI has an expense ratio, or in other words, a fund fee of 0.68%. GPIQ has a smaller fund fee of 0.29%, but TDAQ's is higher at 0.83%. These fees are deducted daily on an ongoing basis from the fund's net asset value and is subtracted before any returns are calculated. Well, there are several advantages to these QQQ-related high-income ETFs. One, they provide high yields of income on a monthly basis. You don't have to wait for a quarterly payment. Two, unlike many weekly high-income ETFs, these three ETFs have been able to either keep or enhance their price value since inception. And number three, investors like them because they are a somewhat less volatile way to play QQQ, which in itself is a somewhat volatile ETF with a beta of 1.23, meaning it's historically about 23% more volatile than the overall market, whose beta is 1.0. There are some other advantages as well. These funds can outperform the QQQ in sideways or slightly bullish or slightly bearish markets. High-income ETFs make all of the option decisions for you, such as choosing the strike prices, the expiration dates, and rolling positions. So we don't even have to think about it. We just let management make those decisions for us. And certainly they have experienced people making those decisions. Investors also like that the 100 stocks in the ETF provide more diversification than some of the single stock, weekly paying high-income funds, such as NVDY, which sells call spreads on Nvidia Corp., or TSLY, which does the same on Tesla. They often use tax-efficient strategies on a portion of the distributions that investors receive, so we don't get the same tax bite. And receiving regular monthly income helps investors stay invested through market downturns. Well, there are various ways to enhance the strategy that I have shown here. One way would be to make the first purchase on a day when the QQQ has a major pullback. That would make one's initial purchase price less expensive and increase the yield from the distributions. Another way would be to hold the first ETF past the ex-dividend date and sell it if and when the price rises to be equal to or greater than the purchase price. One would hope their timing would be so good that the next ETF would be purchased after another pullback, but this certainly won't always be the case. It's also possible that the TDAQ price would not retreat before the next ex-dividend date for QQQI, since they are paid fairly close to each other. But since the idea here is to collect the income, even if QQQI has gone up in price, and if TDAQ goes up in price, so will QQQI, we still collect an additional dividend by selling TDAQ to buy QQQI. We may make some money on the difference in price if QQQI goes down after we sell TDAQ, or QQQI may go up after we sell TDAQ and make it a little bit more expensive. But selling GPIQ to buy TDAQ is a little easier because there's much more time between their respective ex-dividend dates. One will obviously have to keep track of when all three ETFs are having their ex-dividend dates so you can make sure that you're buying and selling at the right time. But this can be easily done just by typing the question into Google: when is TDAQ's ex-dividend date, when is GPIQ's ex-dividend date, etc. Well, summing up the high-income ETF strategy, the strategy discussed here is to buy and sell the Goldman Sachs Nasdaq 100 Premium Income ETF, the TAP Alpha Innovation 100 Growth and Daily Income ETF, and the NEOS Nasdaq 100 High Income ETF. These are three QQQ-related high-income ETFs. Each one would be purchased a few days before its ex-dividend date, and then sold, hopefully at break even or a profit on or after the ex-dividend date. If we don't have a profit, if it is close to the price you purchased it, your dividend or distribution payment would still exceed the loss, making it worthwhile. After selling the first ETF, we would buy the next high-income ETF and then sell it at break-even or profit on or after its ex-dividend date. Then we would use the same strategy for the third ETF. This strategy is best employed in an IRA account to avoid short-term capital gains, as the distributions will be non-qualified, meaning held less than 60 days. It's clear that the total returns with appreciation of all three ETFs have vastly outperformed just their income yields over the last few years. However, none of them have really been tested in a long-term bear market. Still, QQQ has had several significant pullbacks since 2023 that have easily been weathered by these funds. We should also not assume that whenever an ETF is sold, it will be at break-even or at a profit. Any losses incurred would negate gains from the distribution. However, when one of these ETFs declines in price, the next one purchased will also be less expensive. If the ETF appreciates after it's sold, the next one purchased, though more expensive, should generate a higher distribution. Holding just one of these QQQ-related high-income ETFs would give an investor a yield somewhere between 10 to 16% annually, and that's pretty good. But by buying and selling each one, we can boost our return considerably. The combined total distribution yield of all three ETFs is over 40% annually, but that's not including any appreciation or depreciation of the ETF price. Also keep in mind that each individual investor may do better or worse depending on when they buy and sell each ETF. In a bear market, most or all of the combined distributions could be wiped out, but unless the Nasdaq 100 drops more than 40%, losses should be minimal. It's also worth noting that buys would be less expensive as the bear market moves along, allowing for more shares to be purchased. Distributions, of course, will be lower as well. Given their performance thus far, and since bull markets last longer than bear markets, this strategy over a long period of time should do very well. Unfortunately, these ETFs are too new to be able to judge them over a lengthy period. There are a few other QQQ high-income ETFs that I have not covered here, such as JEPQ, IQQQ, and QYLD. If you own any of those, put a note in the comments section to let me know how you're doing. Well, I want to finish this video by telling you about a July 4th Independence Day special at my TQQQacademy.com website. You now can get 20% off all TQQQ and other full-length courses, mini courses, and ebooks now through July 5th, 2026. All you have to do is use the code word INDEPENDENCE at checkout to get your discount. And I will put the link in the first comment below this video. Well, this is Ethan Roberts for Mastering TQQQ Trading, saying have a great Independence Day and weekend, and I will see you soon.